So, welcome to the 90-minute webinar of the Ultimate Guide to Liquidity. Now, this is material of the Lions, and that's a community that I run. I will explain more about it later on. So, this is going to be based off of a book that I wrote called The Ultimate Guide to Liquidity. And I'm going to try and convey as much information as I can in one lecture. So, without any further ado, let's get into it. So, before we start this, everybody must understand the first division. What is liquidity, right? So, in order to best understand liquidity, then we must go to the root of liquidity. What is the root of this thing, this concept, liquidity? Well, we got to start by understanding the definition. We got to understand by understanding what we're talking about. So, what is liquidity? So, liquidity, okay, so the word liquid is something that flows. So, liquid is something that flows. So, if liquidity, as in water, flows from rivers to oceans and from oceans back to rivers, liquidity, as in the financial context, is money. Money that goes from your pocket to companies and from companies back into your pocket, or from your pocket into assets, and from these assets back to your pocket. That is in the financial context. Now, what is the word liquidity actually in the financial context, right? It's not cash in the financial context, because when you go to pay somewhere, they don't tell you we accept credit card or liquidity. They tell you we accept credit card or cash. So what is liquidity? Well, liquidity is how much cash you have available. For example, if somebody asks you how liquid are you, they're pretty much asking you how much cash do you have available. So if your portfolio is consistent of 2 houses worth $1 million and $500,000 cash, you're 66% illiquid and 33% liquid. You have 33% cash, which is liquidity, and you have 66% in assets. Now, what differs liquid from illiquid? What differs cash from assets? Why do we call them differently? The reason we call them differently is because of their ability to be exchanged. So cash is easily exchanged for anything you want. You can buy whatever you want with cash. You can buy an expensive watch. You can buy a house. You can buy cars. You can buy food. You can buy whatever you want with cash. But for example, with an asset such as an expensive watch or a house, you can't buy many things. You have to first liquidate it, exchange it for cash, hence the term liquidate, and then you can use that. Okay, so in order to make use of it, you need to first liquidate it. You need to first turn it into cash. So in the trading context, it is much similar. The contract that you have, let's just say you have a Bitcoin position, you have a Bitcoin long position. That's a contract. That contract is an asset. It's worth money, but it's not money. It's worth money, but it's not money. So that is why when you have a position, you're illiquid. And then once you close your position, you actually liquidate. So that is why when we, for example, when we hit stop orders, you hear the term liquidation. Whenever somebody liquidates a position, he's closing it. So whenever we hit a stop order, whether that be stop loss or take profit, you will see liquidations. Okay? Now, in the trading context, when people talk about liquidity, they typically refer to the stop order, specifically stop loss. So when I'll say there's a lot of liquidity in this area, I'll typically be referring to stop losses. In other words, you can just flip the words and think as if I'm saying there's a lot of stop losses in this area. Okay? That is liquidity. I hope I was very clear, and I hope everyone now understands what liquidity is. We'll proceed. So, on to division 2. Why does liquidity matter? So, the first thing you must understand when we're talking about buying and selling volume, there is always equal buying and selling volume. There's never more buyers than there are sellers. There's never more buying volume than there is selling volume. Never. That's never a scenario. It's impossible. There's a law. It's like a law. If I sell you an apple, I sold one apple, you bought one apple. I can't sell an apple if you don't buy the apple. Okay? The only thing that changes is the price that it was sold for. That's the only dynamic thing that may indicate on who was being more aggressive. But there is always equal buying as there is selling at the current price. Okay? That is always parallel. It's always exactly equal to the cent. Because I can't sell you an apple if you're not going to buy it. Okay? That's impossible. So now, why does this matter? Why are we even talking about this? Well, the reason we need to talk about this is because you must understand, whenever you execute a position, there's somebody on the other end of that position. Whenever you make $100, somebody loses $100. Not necessarily one person, but maybe collectively a few people. Or that's a part of somebody's bigger position. Either way, when you make $100, someone or a group of people lost $100. So when you take that money from the markets, and when you lose $100, you give that money to the markets, somebody else is receiving that money. Okay? You must understand there's two ends to every single deal, to every single transaction. This means that if you want to enter a position, somebody is entering the opposite position. Now, why does this matter? Well, if you're a smaller player, then you don't really need to consider it so much, because if you want to enter a position as a regular average retail trader, then it doesn't matter so much. Because if I want to go long with $100, say, there's always going to be someone on the other end at this price that wants to go short with $100. There's always going to be someone to match me, to facilitate my trade. But if I am a very wealthy player, if I'm a billionaire and I want to put down $1 billion, I need to find someone else who's willing to put down $1 billion at that price, at that time. And often that is a very complicated task to do with such amounts of money. And this is why liquidity matters, because these larger players need to find people who they can pair their orders with. Otherwise, they cannot fill their orders, and this is why they need to accumulate the orders through large periods of time. So, if they intend on accumulating $1 trillion position, that's gonna, well, on the euro dollar, they could probably do that within a few days on the euro dollar, because there's over $1 trillion volume per day. But if they want to do it on something like Bitcoin, then that might take them much longer than that. This is why liquidity matters. It doesn't matter to us, but it matters to the bigger players who manipulate these markets. Now, we're going to get into that in the next division, so I'm going to talk about that then. And this is why you need to think about liquidity if you want to mimic the actual smart money. So, division 3, smart money versus dumb money. So I'm going to begin with some statistics. So the first statistics I'm going to mention is that 95% of retail traders are losing. Their portfolios are in a net loss. Now, if we would try to make sense out of this, right? Let's just try and make sense out of this statistic. Let's just say you approach the markets from a standpoint that you are going to flip a coin whenever you execute a trade. So whenever you execute a trade, you're going to flip a coin. So long or short, that's completely random. Stop loss, take profit, you flip a coin for both of these. Those are completely random values. If you were to do that from a probabilistic standpoint, after spreads, commissions, and slippage, etc., you should be slightly, your P&L is going to be fluctuating around break even, but it's going to be leaning towards the negative because of commissions, spreads, and slippage. But it's only going to be slightly negative. It's not going to be like tremendously negative. But this could excuse a lot of the losers, but it cannot excuse 95% of losers, especially when you think that these people are people who are trying very hard to be profitable. There are people who are applying a strategy. There are people who are trying to make money. They're not coming in with the mindset that they want to lose their money. They're coming in with the mindset that they want to make money. So how come when they apply these things, they become so unprofitable? How come it's so easy for someone to completely blow an account, but it's 10 times as hard to double their account? How does that make sense, right? Make it make sense. Because if it was completely random, like it's as if you went to a test, to an exam, to a quiz, where each question has two options, and you would consistently, without knowing anything, you would consistently fill in the wrong square. How do you know to fill in the wrong square? There has to be a degree of manipulation for you to do that. It either has to be deliberate from your end, or someone else has to lead you to that decision. Because it cannot be random. If it was random, then the statistics would reflect that, but they don't. They reflect that it is extremely to one end. That is the equivalent of the statistics we're seeing in these markets, which proves to us that there's some type of manipulation going on. Whether you like it or not, that's a fact. Now, let's go over to the next talking point. So, the gap between winners and losers. Take a market. Let's just say there's some people who win consistently and there's some people who lose consistently. We know that to be true because we know that there are consistent traders who consistently win, and there's consistent traders who consistently lose. Take that process of you consistently losing or consistently winning, a group of people consistently winning versus a group of people consistently losing. Take that and spread that over 5, 6, 7, 8, 10, 20 years. The longer it goes on for, the richer the winners become and the poorer the losers become. It is for the simple reason that winners take money from the losers and losers give money to the winners. So as a consequence of that, there's a perpetually growing gap between winners and losers. The winners are consistently taking money from the losers, and the losers are consistently giving money to the winners, which means the winners become extremely wealthy while the losers become extremely poor. But wait. So the winners are very rich and the losers are very poor across a very long period of time. What does this mean for us? Well, remember what I said earlier, that there's two sides to every transaction, right? There's winners and there's losers to every transaction. There is an equal volume on both ends. Equal volume on both ends, okay? So if this end has $500,000 volume, then this end is going to have $500,000 volume. If $500,000 were lost on this end, then $500,000 were gained on this end. This means that the rich winners are responsible for an equal volume as the poor losers. How does this make sense? The only way it could make sense is if there's a small group of winners and a large group of losers contributing to that pool, which creates the volume. So this proves to us that there is an elite group of people who are consistently taking money from all of the losers. There is an elite group of people who are consistently taking money from all of the losers. Now, the only way this would make sense is if they are manipulating price. Now, let's take a scenario real quick. Let's try and think of a scenario. Like, some people bring up the theory that the elites might not be all on the same group together. Let's take a scenario real quick, just so that we can understand this better from their point of view, okay? Let's just say there is one guy who's the richest player in this game, has $1 trillion. There's another guy below him who has $200 billion, another guy below him who has $100 billion, and so forth and so forth. Now, let's just say the guy with $200 billion thinks, okay, I have a lot of money, more than the daily traded volume of this asset. I can definitely manipulate this price. And he tries to bring the price down. So he goes ahead and he facilitates all of the longers below him. He just shorts and shorts and shorts into shorts. He's exhausting all of the longers to move price down. Now, he thinks it's going to move price down because that's how it's supposed to be. Now, this $1 trillion guy sees an opportunity. He sees, okay, there's somebody who's shorting the markets with large volume, with a large volume of money. And he thinks, and this $1 trillion guy thinks, okay, I probably have more money than this guy. So what he'll do is he will facilitate all of his shorts. So he will offer longs to every single short position that this guy sends into the markets. Now, this will continue. So this guy will add more shorts and this guy will add more longs until one of them runs out of money. Now, the person who's going to run out of money first is going to be the guy with $200 billion. He's going to run out of money. And what happens when he runs out of money is the $1 trillion guy is going to be left with $800 billion more, which he can use to manipulate price. So now at this point, all he has to do is manipulate price up. And now the $200 billion guy is going to be underwater in his shorts, and he's going to have to find a way to liquidate them. And when he liquidates them, the richer player, the $1 trillion guy, is going to take him up on the offer, and he's going to essentially realize his positions through him. And that's how the $200 billion guy is going to lose his money, and the $1 trillion guy will take his money from him. Now, all the wealthy players are aware that this is exactly what would happen if they made an attempt at manipulating the market against all the other big players. So instead, the only way as a wealthy player you can participate in the markets as a ultra wealthy player is, I'm talking ultra wealthy, like billions and billions and billions of dollars, is to be part of their gang. So if anyone who's not part of their gang is just gonna lose. Whenever he tries to manipulate the markets, they're gonna go against him, because why not? They would want to make money. He would lose money and he would get burned. So it's either you join or you can't do anything. Okay, or your money is useless. So up until this point, was I clear? Do you guys have any questions? I'm gonna give you like 30 seconds for questions. Does anyone have any questions, or have you guys been following? Okay, what I'm trying to say is money is power, and the most coordinated group of power is the one that's going to have the strongest punch, pretty much. So let's just say trading is a zero-sum game, but let's just say there's all of the money, and all of the money collectively probably has more money than these elites. But the thing is about the money is that they're not coordinated. They are each man separate. And because they're not coordinated, they can't manipulate the markets, because let's just say the money puts down $1 billion of short volume. This elite guy is going to see an opportunity to capitalize on to go long with $1 billion, and he's going to make these guys lose because they're going to run out of money. If the money was coordinated, then it would be possible, theoretically, but it would be statistically impossible, probabilistically impossible for that many people to coordinate. So that is why they can't do anything about it. Now, let's continue. So how the elites manipulate price. Wait, okay, let me just read real quick. So quick question, these are generic concepts, right? They would apply in the future. Yes, these concepts would apply in the futures markets as well. Well, no, what I'm saying is there is no war between these large institutions, because if there was, it would end so quickly, because this guy is going to get burned instantly. Anyone who tries to go against the stronger guys is instantly going to get burned if you're going against them with a large amount of money. So if I was now to go into markets, let's just say I have a time machine price went up from December 1st to December 2nd, price went up. If I go back to December 1st and I go to December 1st and I long with $50 billion, price is not going to go up from December 1st to December 2nd. It's going to go down. Why? Because these elites are going to see, okay, there is an opportunity for us to go short with $50 billion against this guy and then use our large sums of money to manipulate price down in case he tries to buy more longs. Okay? So if I were to go back to December 1st and long it with, say, $1 million, then it probably wouldn't make a difference. But with large sums of money, then it's going to make a difference. Okay? Okay, we're going to continue now. So how do these elites manipulate price through supply and demand? So first off, we must understand supply and demand as if it was not manipulated, and then we will explain it as it is in reality. So in a perfect world, or actually in a natural market, in a market that's not manipulated, this is how supply and demand is. Imagine there are 10 shelves for apples in the local market. There is a shelf for $1 apples, $2 apples, $3 apples, all the way up to $10 apples. So there's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. And there's supply at every bench. Right now, as a seller, you'd naturally be more inclined to put your apples, list them for $10 because that's the higher price. But if you put your apples at $10, there's likely going to be someone else who will list them for $9. And then the buyers will prefer to buy from him and not from you. So the competition between sellers brings the price down. So now let's just say there are some sellers who are willing to sell it for $1. Not many, there's very few. There's a bit more sellers who are willing to sell it for $2. There's a bit more who are willing to sell it for $3. There's a bit more who are willing to sell it for $4. And then everyone is looking to sell it for $5 to $10. Okay. Now, the bell rings. The market has begun, and the buyers are coming in. Now, all the $1 apples instantly gone. Boom! Price moved from $1. Now the next apple is going to be sold for $2. Boom! People start buying the $2 apples. Now the price is currently at $2 because people are supply and demand is agreeing at $2. Boom, supply is out at $2. Now there's supply at $3. Buyers are buying that out. Now $3 supply is gone. Now $4 supply. Some people want to buy it. Some people don't want to buy it. At $4, price stopped moving up because the demand wasn't willing to match any price higher than $4. This means that the orders to sell apples between $5 and $10 were all left behind. That is how supply and demand works. Technically, that's the technical aspect of it, and that's how it works. Now, what happens in reality in these markets, right? So what happens in these markets is much the same, except the supply and demand in the markets is 100% money. Wait, before I move on to this, I just want to make sure everybody understood and that was clear. Was I clear, everyone? Let me know if you understood what I said. Okay. Okay. Okay, so I'm seeing some requests to go over again, so I'm going to go over one more time. Imagine there are 10 shelves for apples. Each shelf represents a different price. Okay, these are like the books in the markets. There's limits. There's a shelf for sell limits. There's a shelf for buy limits. Okay, so let's just say in this market, there's only sell limits and the buyers coming from the markets. Okay, so you have shelf $1, shelf $2, shelf $3, all the way up to $10. Each shelf represents a different price. Sellers overnight, before the market opens in the morning, they're going to put their stock, they're going to list it for sale on these shelves. So they're going to list apples for $1. They're going to list apples for $2. They're going to list apples for $3. Obviously, as sellers, they would prefer to sell for the highest price possible. But if they list it at $10, there's a very low likelihood that there's going to be any demand at $10, considering these buyers can just buy it from some other seller who's selling for a lower price. So the competition between sellers brings price down to the lowest, fairest price that the sellers can offer to the buyers. Now, the competition between buyers brings price up to the point where it's fairest, fairest to the point it's fair. So if, let's just say, $1 apples are extremely cheap and all the buyers want that, that's going to be sold out instantly. $2, that's everyone wants that. That's going to be sold out instantly. $3, everyone wants that. That's going to be sold out instantly. But $4 is the sweet spot between buyers and sellers, and that's likely going to be the price that the price where, well, the price tag, which price fluctuates around. So the market opens, $1 apples instantly sold out, $2 apples instantly sold out. Now price is trading at $3. $3 apples sold out. Now the next sale price will be trading at $4. Now $4, the stock there is some demand, but it's not getting sold out completely. But there's also no supply at 3, 2, and 1, so price is not going to go down, and that's why price stays at 4. Okay, this is how supply and demand works. Now on to the next. On to how it is in reality. So now in reality, what happens in these markets? What happens is pretty much like this. So I'm going to take a sip of my coffee first, and then I'm going to explain it. In these markets, supply is short contracts and demand is long contracts. That is how price is booked. It's booked based off the exchange rate between longs and shorts, supply and demand. Okay. Now, longs and shorts in reality are money. It's simply money. Money buys you longs and money buys you shorts. Right? So now what this means is that if you have enough money, you can manipulate price completely and utterly. Let's draw for you guys a scenario. Okay, I'm gonna annotate for you guys a scenario. So here. Okay, so so let's just imagine wherever I put this, that's a limit. So price is currently over here. Okay, so I'm going to do it like this. So price is currently over here. Okay, here's where price is at. Now, here we have some buy limits. Wherever I do waves, it's buy limits, okay? Here we have buy limits. Here we have sell limits. And price is currently over here. Let's just say this is the price of $3. This is $5, and here is $2. So price is currently at 3. The nearest buyer is at 2, and the nearest seller is at 5. So the nearest long is at 2, and the nearest short on the books is at 5. This means that if I were now to buy one long, my long would have to be facilitated. It would have to be paired with a short, right? So where is that nearest short? That's at $5. So the spread is going to be $2. It's going to go instantly from 3 up to 5. Price is now going to be at 5. And now from here, the nearest long limit is down at 2. So now if I were to enter one short position, then price would instantly drop down to 2, right? Because the nearest, if I go short, it has to be paired with a long, and the nearest long is down here. So price would have to drop over here, and there's going to be a spread of 3, right? Between 5 and 2, there's a $3 spread. This is how price moves in these markets. Now, how can this process be manipulated? Well, let's just say I want to move price up in these markets. Okay, now let's just draw out a graph. So here is the price of 0. Here is the price of 1, 2, and 3. Okay, so now let's just say price is currently trading at 0.5. Or let's just say it's currently trading at 1. Okay, so price is currently trading at 1. Now let's just say I want to move price up to $5 or to $3. So let's just say I want to move price up to $3. If I want to move price up to $3, the way I'm going to have to do that is I'm going to have to buy out all of the limits until $3. So there's going to be supply. I'm going to have to buy out all of the supply until $3. So there's going to be supply over here. There's going to be supply at $2. There's going to be supply over here. I'm going to have to facilitate all of this supply, all of these shorts. I'm going to have to facilitate them by offering them longs. So let's just say there is $5 billion of volume of supply between 1 and 3. I'm going to have to use up $5 billion of capital to bring price up to 3. So I'm going to have to, if I want to bring price up to 3, I'm going to have to long with $5 billion. And within this, I have accumulated my long position. Now, currently, I would be in a long position until these shorts would want to, until I close it. So until I offload it to somebody who's looking too long. So now, this is how you can manipulate price. You just need enough money. This just proves that if you have enough money, you can move price wherever you want. Now, let's just say there was a richer player than me. If there was a richer player than me, then as I would be buying out the supply, he would notice that. And what he would do instead is initially it would go up a little bit, let's just say. Now he would notice that. Now he's going to be offering me shorts. He's going to consistently offer me shorts, say at this price. At the price he doesn't want it to go above. So let's just say he doesn't want it to go above this because there's supply here that he does not want me to interact with. What he's going to do is he's going to offer me the supply over here at this price. And no matter how much I buy, price is not going to go above this point unless he runs out of money. So now it's just going to be a competition. Who runs out of money first? Let's just say I ran out of money first. Now I'm at his mercy. So now if he can drop price down to here if he wants. He can drop down price even to 0. That's also possible. That happened on crude oil. If you guys take a look, that happened on crude oil. Price went to precisely 0. He can even drop it to 0 if he wants. The way he does that is he sells a contract for $0 and the price will be at $0. Okay? This is how you can manipulate price. Do you guys understand? Was I clear? Okay, I will give a quick recap. So if I want to move price from say $1 to $3, I simply need enough money to buy out all of the supply between $1 and $3, and I need enough money to buy out any potential supply that will be introduced as price moves up. So if as price moves up, there's more supply coming in, I need to have enough money to cover that. I need to have enough money to override that supply. So I need to have enough money to absorb that. So assuming I have all of that, then I can manipulate price wherever I want, to wherever I want, whenever I want, because there's no competition. I have a monopoly, pretty much. Okay? That is how you can manipulate, anyone can manipulate price, assuming they have enough money. And unfortunately, there's only one entity which can manipulate price. And we don't know exactly who that is, but we can make some speculations, but I'm not going to get into that. So there's only one entity. We're going to call them the elites. And these are the only people who can manipulate price. Nobody else can, because if anybody else tries to, then they will just capitalize on them. Okay? This is why all the ultra wealthy players need to either work in coordination with the elites or not at all. Okay? Now we can move on to the next division. Division 4, finding liquidity on the charts. So, first off, you must understand who is the dumb money. So the dumb money, there's plenty of dumb money. There's also dumb money among the institutions, and there is dumb money among retail traders, among banks. But the dumb money is mostly, I'm not sure if mostly, but the best community to target as dumb money, to label as dumb money, is retail, because 95% of retail lose money. Dumb money is anyone who is not profitable in these markets. They are dumb money. They're the people who you want to counter. Why are they unprofitable? Because they haven't matured out of their emotions. The only language that all us traders globally speak, globally understand, is emotions. We all react to emotions. And this is why it's so easy to lead us like sheep to the wrong decision. This is literally how the algorithm is coded. It's coded to manipulate deep psychologically. Think about it. Every time you make a decision based off emotions, based off greed, based off whatever, based off euphoria, based off fear, it always goes against you. Price always goes against you when you make a decision on emotions. This is why dumb money is people who act on emotions. That's dumb money. And that is dominantly, dumb money is dominantly, well, retail is dominantly dumb money. 95% of retail are dumb money. Now, this doesn't mean that support and resistance traders are dumb money. Support and resistance traders, you can be profitable with support and resistance, and you can also be profitable with countering support and resistance. It all comes down to how you understand risk management and how you understand probabilities. And do you act on emotions when you apply it or not? Okay. So if you act on emotions when you apply your strategy, no matter how good your strategy is, you're going to lose money. If you don't act on emotions, then you're going to be smart money. Simple as that. Smart money is anyone who has matured out of his emotions and has the right approach. So if your approach is to be profitable and you have matured out of your emotions, then you're going to be smart money. Okay? That's the smart money. Now, who creates liquidity? Well, all of us create liquidity. When I enter a position, when I give cash for an asset, I am offering liquidity, cash, I'm offering liquidity for an asset. And when I exchange the asset for cash, then I am liquidating. I am taking liquidity to liquidate myself. Okay? So me, you, everyone create liquidity. We offer liquidity and we take liquidity from these markets. We give and take liquidity to these markets. All of us, everyone, absolutely every single one. And price will go against the consensus. Price will go against the consensus among dumb money, because that is where the most profitable move is. So dumb money is sometimes going to be profitable, sometimes they're going to be unprofitable. But overall, if you were to combine every position, it would be a net negative. So if you were to combine every position executed in this day, let's just say among dumb money, there were more longs than shorts among dumb money, then price must have went down at that time, because the most profitable move was to the downside for the smart money, because they got to capitalize on the gap between shorts and longs. So if there was 100 shorts and 500 longs, then the smart money is going to facilitate those 400 shorts, and they're going to offer them that liquidity, thus balancing them. Okay, and then the longs are going to lose money and the smart money are going to gain money. Okay. Everything clear so far? Okay. So now the next thing you must understand is how traders make decisions, because if you want to be able to counter the consensus, then you must understand how traders make decisions. If you understand how traders make decisions, both strategically, right, logically, and both irrationally, then you are going to be able, and both emotionally, then you are going to be able to understand what the consensus is. You're going to be able to understand what most people are thinking and doing. More importantly, doing. Okay, and that is how you can understand what the smart money is doing. Because if you can understand what most of dumb money is doing, then you can understand what most of smart money is doing. Because smart money is always going to be doing the opposite of the consensus among dumb money. Okay, so let's get into chart examples. So give me a second. I'm going to pull that up. So let's start with this example. So here is an example for how retail traders make decisions. Okay. Retail traders, the reason I'm referring to retail traders and not dumb money is because most of retail is dumb money. Okay. And if we understand the consensus among retail, then we understand the consensus among dumb money. So over here, you can see we have a level that has been respected multiple times. This level is identified in human pattern recognition, and it's going to hypnotize traders into thinking that it will be respected. They will see, okay, price was respected here, respected here, respected here. They see it this way. They think, okay, now because there's this level, then there is going to be a lot of supply at this point. And because there's a lot of supply at this point, price should not go through it. What they don't understand is that the markets are manipulated. And because there's supply at this point, that's an opportunity for the smart money to buy out that supply and then move price up and distribute it to the buy side liquidity up here. That's what they don't understand. Now, after price breaks above this level, at this point, it's an extremely obvious level. All of retail are going to be hypnotized by this level, and they're going to be looking at it for longs. They're going to be looking to long it over here with a stop loss where? At the first low under support. So the first low under support, that's where traders set their stop loss, because they think the demand over here is going to stop price from going under it. It's going to protect price over here. And they think, sure, price might wick a little bit under because of the difference between exchanges, but price should be respective of this point because there's a lot of demand over here. What they don't understand is that that demand can be used by the smart money to enter a short position, which they can then distribute to the sell side liquidity over here. And this is how retail would be positioned. Retail would have a long over here with a stop loss right over here, and they would be stopped out right over here. Okay, that, and only after they get stopped out can price deliver the targets, because of the core principle of liquidity. The core principle of liquidity is that within every maneuver the market performs, most of retail is going to be unprofitable. If you were to combine their positions, most of retail is going to be unprofitable within every maneuver. So if price perfectly respected the level and just ran up without stopping them out, then that would invalidate the core principle of liquidity. On to the next. Wait, so far everything clear? You can react with thumbs up, by the way. Okay, I see the thumbs up. Okay. If anything's unclear at any time, just write in the chat. Okay, please come again. I'm going to go again one more time. So retail thinks that there is demand over here. Because they think there is demand over here, they think that there's not going to be enough sellers at this price to move price beyond it. Because everyone collectively thinks price is going to go up. And that is why they're going to look too long over here where they stop over here, thinking that this low is protected. But because the markets are manipulated, because the elites have more money than retail, then the elites will facilitate retail's trade and manipulate price down to capitalize on retail's loss. Once retail realizes the loss, the elites will realize the profit. So if retail offers liquidity here and takes liquidity here, the elites are doing the exact same thing, except they're on the other end of the deal. Okay? And that's how they capitalize on the move from here to here, and they also capitalize on the move from here to the buy side liquidity. Okay? We will get into that in the future, into your question. All right, let's continue on to the next example. Here's the next example. So in this example, retail is looking to go short over here with a stop loss at this high. Why this high? Because it's the first high above resistance. And there's also some liquidity probably resting on this and these highs as well. One sec. Okay. Oops. 1 second. Just give me a second. Okay. So retail sees this level. They're all hypnotized by this level. They see price respected it here, 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 here. So what do they think price will do next time price comes to it? They think that price is going to respect this level again. And they will think that the first high above it is going to be protected. They think it's going to be protected because there's a lot of supply over here. If there's a lot of supply over here, then price should not go beyond it because there's not going to be enough demand over there to match that supply and beyond. Little do they know, the elites have more money than them, and the elites are looking to facilitate their trade. Thus, the elites are going to buy out all of the supply, and they're going to liquidate it at these highs. And only after they liquidate it and capitalize on this loss is only after they do that, only then will they move price down. Do you understand? Now, the main thing I want you to take away from here is how retail thinks. You need to understand how they think. They see support and resistance levels. They see areas that they think have supply and demand. So they're going to look at this level and they're going to think, okay, here we can go short with our stop loss at the first high above resistance. So the main two things you need to memorize here is stop loss for longs is at the first low below support, and stop loss for shorts is at the first high above resistance. Okay, two things. Stop loss for shorts at the first high above resistance, stop loss for longs, first low below support. Those are the two things you need to memorize. Okay, only two things you need to memorize. And you need to understand, you need to have this understanding and logic. Okay, you always need to think, okay, what can the elites do versus the dumb money? Now, let's continue. Here. So, liquidity and human emotions, division 5. So the first thing you guys need to understand about emotions is you need to understand a little bit of neuroscience. Okay, that is the prefrontal cortex and the amygdala. So the amygdala is the part of the brain that's responsible for the emotions, and the prefrontal cortex is what's responsible for rational thought. Now, in situations which are emotionally heightened, the amygdala is often quicker to respond than the prefrontal cortex, which makes it easier to make irrational decisions over rational decisions. So when you're trading, when you're in front of the screens, you got the money, everything, you see the numbers, the P&L, prices moving up and down. your amygdala is responding much quicker than the prefrontal cortex is. Okay? So you are more likely to act on emotion than ration. And this is something that is among all humans. All humans react to emotions. And whenever you react to emotions, you're typically making a mistake. Now, in real life, there may be more instances where the emotional reaction could potentially, by chance, be the good reaction. But in these markets, the emotional reaction is almost always going to lead you to losses. Almost always. Okay, the emotional reaction is all, and because that is a language that everybody reacts to. So if all of the money is doing something collectively, what is price going to do? It's going to go against it. Okay, it's going to go against it. That is human emotions. This is why there's also the saying, I'll think about it and I'll get back to you, because when you think about it, when you distance from the event, then you're no longer as emotional. Distance from event helps you be rational. Hindsight helps you be rational. When you read all of these heinous acts that happen in history, you can't really judge these people because you don't know what they went through at the time. You don't know how their amygdala was responding to what they were experiencing. And at the time, it would have seemed like the proper reaction based off emotion, but not necessarily based off of logic. And that is pretty much emotion. That's why hindsight is so easy, but real time is much harder. Now, convenience, this is a concept that I invented. Convenience rationalization. What is convenience rationalization? It is when traders rationalize through emotion, they rationalize the more convenient scenario as the correct one. They classify that as the correct one rather than the actual one that's good. So if there's two scenarios, one of them is supposed to be the good one of them is supposed to be the bad one, but the bad one is more convenient than the good one. It's easier. It's more convenient for you. Then you will think the bad one is the good one, and you will think the good one is the bad one. You will think the bad one is wrong and that the good one is right. Okay? Now, what am I trying to say over here? Where does this apply to the markets? Imagine we are in a downtrend, okay? So we are in a downtrend. Price is aggressively trending down. And now you see this consolidation over here like this. During this consolidation, it is much easier to go short, to go long than it is to go short. During this move down, it's much easier, it's much more convenient to go long than it is to go short, because the rational short, according to most strategies, is going to be way up here. It's going to be way up here. So it's much easier, it's much more convenient to go long. And in cases like this, most people are going to be knife catching. They're going to be trying to catch the bottom. And only once there's enough pain and price is fucked around enough, boom, now will it go up and it will not stop until it reaches its objective. So here, convenience rationalization, even though people were bearish, it was more convenient to catch the bottom. It offered more risk to reward. It was more attractive. So people were fighting this downtrend instead of joining it because they could not join it. It didn't offer them opportunities to join it. And that is why people would have been on the long side of this. And that's why price would have went down. Okay. And then over here, it would be more convenient to go short because now it's at your POI. So the stops are up here. So now price is likely going to boom because it's more convenient to do that. And now at this point, you're pissed. Now you're going to be like, okay, fuck it. I'm going to go long. And now they're going to distribute on you all the way down. This is liquidity and human emotions. Now, I already went over this part, so I don't need to go over it again. So let's move on to the next one. So dumb money versus smart money. Smart money position in theory, division 5. So smart money versus dumb money. We already understand that dumb money and smart money are doing the opposite of each other. So they're fighting each other. They're taking money from one another. Smart money is taking money from the dumb money pretty much all the time, collectively. Individually, sometimes smart money, sometimes dumb money individually, but collectively, it is every time smart money is taking money from dumb money. Okay? Now, what does this mean? This means that there must be an inverse correlation between their positions, because for me to lose money while you make money, say price went up. If I lost money and you made money from price going up, that means that I was short because I was losing money and you were long because you were making money. That is smart money versus dumb money. If price went up, dumb money was short, smart money was long. That's the inverse correlation between their positions. This means if smart money's positions were overly long, then that means that dumb money's positions were overly short. Here is where comes in open interest. So if you guys know what open interest is pretty much how many positions, unsettled positions, unrealized positions are running at this point. So if there's currently $1 million in longs that are not realized, that are still illiquid in these markets, then open interest is going to be at 1 million. Okay, there's 1 million in longs, so there's 1 million in shorts as well. So open interest is currently at 1 million longs, 1 million shorts. Okay. If there is open interest of $3 million, well, if there's a $3 million in longs, then there's open interest of $3 million. That is open interest. It's pretty much how many positions are open right now, unrealized. That is open interest. Now, how can we use this to understand accumulations and distributions? Well, accumulations is pretty much when the smart money is accumulating position. It's price moving in a fashion which increases the open interest. So if the open interest is increasing, that means that the smart money is accumulating a position. So if price is moving in a fashion which is causing the open interest to increase, that is smart money accumulating. If price is moving in a fashion which causes it to decrease, then that is a distribution. Now, let me show you guys an example of that, how it would look like in price. So let's just say price is displaying you this. Let's just say this is the optimal trade entry. So traders are looking to go short inside of this box. If price now goes up to here, it goes up to here, and it spends time here, the more time it spends here, the more open interest, the more the open interest is going to be increasing. Okay, so if there is, in this scenario, let's just say most of the money wants to go short when they stop up here, open interest among the money in shorts is going to be increasing, which means open interest among smart money and longs is going to be increasing. This means that the smart money is facilitating the dumb money's shorts over here, and this accumulation is causing open interest to go up. Open interest is going up in this accumulation. Now, the distribution would be, open interest decreasing would be when price runs these stops. When price runs these stops, these positions get realized. The liquidity gets taken out of the markets, which will send the open interest right back down to where it was. That is accumulations and distributions. It's fluctuations in open interest. A spike up is an accumulation or a steady move up typically, and a spike down is a distribution. That is open interest. I will repeat it one more time. So when a lot of people are entering positions, then the amount of unrealized positions in the markets is increasing. Therefore, open interest is increasing because there's more unrealized positions. Now, if their stops are resting up at this point, if their stops are resting up there, then that means that once price reaches that point, these positions are going to be realized. So until price reaches that point, the open interest should be increasing. Once price reaches that point, open interest should be sent right back down. That is accumulation, price moving in a fashion which increases open interest. And this is distribution, price moving in a fashion which decreases it. Open interest is, if you could segregate the time frames, if that was possible, then it would be different among each time frame. But because you cannot segregate the time frames, you can only see the total positions coming into the markets, then the data we are receiving regarding open interest is very low resolution. This is why I teach you guys how to find it on the charts rather than get it from low resolution sources. Because if you were to combine the 1 minute with a 5 minute, with a 15 minute, with the 1 hour, with a full hour, with the daily, with the weekly, with the monthly, then you would get a very low resolution statistic. Like if open interest is going up, you don't know if that's relevant to the daily chart or weekly chart or full hourly or hourly. Maybe on the daily, maybe on the hourly chart, it's going down actually. You don't know, right? So you cannot segregate the time frames, and that's why the data you'll find online is low resolution in this for open interest and for positions in general. But I can teach you how to find it on the charts based off of theories which give you which give you pretty accurate data. I mean, that's how I trade. I trade based off of speculations. I speculate how many positions are open. I mean, if there's more than, so let's just say I think there's more shorts than longs among the money, then I will think, okay, if there's more shorts than longs among the money, that means that smart money must be facilitating that with longs, which tells me smart money is long according to my speculation, which is how I acquire data, okay? So that is open interest, accumulations and distributions, the inverse correlation between dumb money and smart money. I hope it all makes sense. Before I continue over to the next slide, because we went over a lot of information, just react with a thumbs up if it made sense to you. Okay. Perfect. Oops. Okay, so now we're reaching the lion's reversal, which is pretty much, I'm going to conclude everything I just taught you with a model which you can apply to the charts to take trades. Based off of everything I just taught you, you're going to now receive a model which you can trade live. And I'll also show you how I do it live with this. And I'm going to show you examples which I was very public about. So I showed the analysis before I took the trade. I showed when I took the trade, and I showed when I closed it, all in real time, all posted both in my Discord and on Twitter publicly. Okay. Just so you guys understand, this is no bullshit. This is how I made 44% on my account in June. This is how I lost 1% in July. And this is how I made 10.5% in August. July, I lost 1%, not because of the strategy, but because I was being emotional. I took 90 trades that month or 70 trades that month, one of the two, which was way too much for my strategy. So that just shows that I was making bad decisions. Anyways, what is the lion's reversal? So the lion's reversal is pretty much my way of finding a reversal. It's my style of finding a reversal. Now, if I'm going to base it on everything I just taught you, then for a reversal to occur, we're going to need the following things to happen. We're going to need smart money to be in long positions. And we're pretty much the fundamental, at the foundation of it, smart money's positions have to shift from short to long for a bullish reversal. The positions have to shift from short to long. Now, for us to find that, because that's very hard to find accurately. So how do we find that? Well, we have to give room for error. So the way we give room for error is by applying a certain set of criteria. So the set of criteria that I apply to assure that my speculation has a high probability of playing out, I'm going to type that out right now. So 1, you want smart money to realize shorts. 2, you want smart money to dumb money bearish sentiment. 3, smart money accumulate open longs. Okay, so here. You should see it on my screen now. So, realized shorts, what does this mean? Smart money realizes shorts at sell-side liquidity. So, for a bullish lines reversal, we need to clear sell-side liquidity. This means that smart money realized shorts. Now, the second thing you need is dumb money needs to have bearish sentiment, because that bearish sentiment is going to incentivize the dumb money to go short, which is going to allow the smart money to open longs. Okay, that's the second thing you need. Now, the third thing you need is for dumb money to act on that sentiment. So you need smart money not to just be bearish, to actually enter a short position. So when the dumb money enters a short position, then smart money opens longs, and now we have the third criteria. Now, I'm going to show you how we apply this criteria on the charts. So let's go on the charts, and I'm going to show you where I apply this. So division 7. So I'm going to start with this. So I'm going to start with, actually, okay, so these are the trades I'm going to be breaking down. So all three of these trades were 3 consecutive wins that I publicly shared on Twitter. Okay. I shared the analysis before the trade. I shared when I executed it. You can go on my Twitter and you can find this. I shared when I executed it. And I shared when I closed it. Okay. So this one, I had a bit that I closed above here, and I had a bit that I closed below here later on. I believe, I'm not sure where it was, but overall, the average was around here. That's where I got out. Now, I'm going to explain everything that I did over here, okay, and how it lines up with the logic that I've taught you. So, when I saw price trading below this line, I knew that we cleared sell-side liquidity. So, us clearing sell-side liquidity means smart money realized shorts, which it gives me my first criteria. So here we have criteria number 1. Now I just looked for bearish sentiment. So what was I looking for us to have bearish sentiment? Well, I was looking for us to clearly close below this level. So over here, yes, we closed, but notice that swift reaction to the buy side. This entices traders to fight the trend, knife catch, and go long because they think the bottom is in. And even though they would be bearish, they would be longing over here. So what am I waiting for? I'm waiting for these knife catchers to get stopped out over here. Indeed, they got stopped out. And then I'm waiting for the dumb money to enter shorts. Now, where did the dumb money enter shorts? The dumb money entered shorts once price interacted with this level. So I waited for price to interact with that level, and then I took my entry down over here. That's where I took my entry. So once price interacted with this level, once price was under the level, we had number 2. Number 2 is bearish sentiment. We had dumb money bearish sentiment. Once price interacted with this level, we had number 3. That is dumb money opening shorts, and that is the lines reversal. Now, why is it so powerful? The reason it's so powerful is because, let's just say we have a graph. Now, this graph represents the smart money positions. The line in the middle is the equilibrium. When it's below it, then they are short. When it's above it, then they are in longs. Okay, so, and when it's added, then they are neutral. Okay, if smart money has realized all of their shorts, then we are at least at the equilibrium if they realize all of their shorts. Now, if they opened new longs, then we are definitely up here at this point. If they only realize their positions and we don't know if they open shorts or longs, then it might be consolidating around here, and we don't have the type of data to be able to predict where exactly is it in respect to this line. But if we can clearly see that they opened longs, such as they did at the resistance level, then we can definitely and clearly say that price is in the long side. Hence, this means we are in a discount. Price is currently trading at a discount. And that is why I bought over here. Now, where do I decide to close my position? Well, when we interact with buy-side liquidity, then the smart money closes their longs. They realize their longs. So that means that when we go above this buy-side liquidity pool, these positions get sent right back over here. So if they want to move price higher, we're going to have to see an accumulation. And that is why I closed around where I closed, because I knew that their positions would come right back down to equilibrium the minute we interact with the liquidity. And then once we clear the sell side liquidity and we had bearish sentiment again, that's going to be setup number 2. That's where we had another Lions reversal. And that is where I entered another trade, which I posted, and you can go on my Twitter, look up these dates, and you will find exactly everything I'm talking about. You will see I entered another trade over here, which I closed right over here. I think I actually closed it slightly higher, but yeah. And then at this point, I was extremely bullish, but I said, I'm bullish, but my system is telling me that I should pay attention for price reversing. So if we are going to if we start going down from here, allowing people to enter longs, then I will flip short. And that is what I did. I flipped short the minute price started rejecting, and I entered my short over here shortly after closing my longs, and I targeted the sell side liquidity, which was resting at these lows based off support and resistance. Okay? Does everyone understand everything I just went over? I would go over this again and again and again, but I am running out of time and I have to, so I'm going to explain one more thing, and I'm going to explain that thing after I tell you guys about the Lions Den. So the Lions Den is a community in which I teach these concepts in depth. There is an 11-day course which you can follow, which will teach you everything about how to trade my perspective of liquidity. So the way I view liquidity, all my findings, all my research, everything I do, all the trades I take are posted in the Lions Den. It's a community with a lot of people that are very active, and there is a very structured format in which you can learn everything that I'm teaching right over here. So if you want to join the Lions Den, which is the best place for you to be if you're looking to learn this strategy, it's the only place you can be if you want to learn the strategy, because I am the only person who teaches it, because these are all my findings. There's other people who may teach you stuff about liquidity, but I guarantee you nobody teaches you in this to this level. And you can either take my word for it, or you can go and take a look for yourself, find out for yourself. So if you want to join the Lions Den, I'm going to post the link inside of my Telegram of where you can buy it. And you will be able to join the Lions Den. There I post every single trade I take, every single one of them. Not a single one is left out. Every single trade I take, I post there in real time. And you can see my stats every month on month on month. I only accept crypto, but I will actually also accept donations to organizations that I believe in, that I like, and I will sort a way for that later, because I'm not, or I will sort a way to pay through credit card. I donate 10 to 20% of my income either way. So if you want to join the Lions Den, I'm going to post a link in my Telegram of where you can read about it and join if you're interested. My concepts are not what ICT teaches, but they complement what ICT teaches. So because ICT at the end of the day, he teaches you how to be the smart money, right? He gives you things that based on statistics can make you smart money if you are able to mature out of your emotions. And it's all based on also on his perception of the algorithm, which For me, it just doesn't click with me, and that's why I had to resort to researching on my own. But if it does click for you, many of my students trade ICT plus liquidity. They will find the liquidity narrative, the liquidity direction, and then they will find a way to trade that through an order block or a breaker block or an inverse fair value gap, balance price range, whatever. So right over here, you can see this would have been the ICT balance price range coupled with the liquidity, and then maybe you would go short with your stop loss up here. I don't know. Based on my teachings, you wouldn't do that, but based on ICT's teachings combined with my teachings for direction, you would. Anyways, I'm going to go over now one more thing, which I said I would go over, and then we're going to call it a class. So let's go over the next scenario. That is the Bitcoin bottom, which I called over here. So I called the Bitcoin bottom right down here, literally on the day of the bottom. I tweeted. You can go on my Twitter and you can find all of this. And you can also find it on my YouTube. I made in-depth explanations and I was ultra vocal about Bitcoin going up to 25K. Which it cleared right over here. Why did I think that? Because we just had a lines reversal, and you can see I was trading these concepts well before 2023. So it's nothing new. It's nothing that I just invented. I've been doing this for a while. I have experience with this. The best place for you to learn about it is in the lines then. Here we have a level of support, and we have the first low below it, which is sell-side liquidity. That's our first element, smart money realizing their shorts. The second element is, while price was over here, more people were fighting the trend based on liquidity and human emotions. People were fighting the trend because it wasn't convenient for them to go short over there. So they were trying to catch the bottom. Knife catchers got stopped out. That's also part of the first element. Now, the money sentiment was bearish because we closed under this. So we have the second element. The third element would have only come once we touch this level. Once we touch this level, boom, everyone entered shorts. And now we have a confirmed line as reversal. And at this point, your targets are going to be first high above resistance. Then once price gets up here, there's going to be another resistance, which creates liquidity at this high. And then once price gets there, it reaccumulates real quick to create more liquidity at this high. And then once it clears that, it creates a double top, which creates liquidity up here. So once price rejected over here, I also called another move up. Let's go. So first, was everything clear here? Do you see the lines reversal that I was teaching? I'm also going to show you at the end of this, for those who stick to the absolute end, I'm going to show you exactly how you can trade it. Okay, so here, this was a lines reversal. Now on to the next lines reversal. This, I was also extremely vocal about it. I called it beforehand. It's my pinned message on it's my pinned tweet on my Twitter. If you go to my pinned tweet, this is not by coincidence, go over there. There's about 7 predictions in my pinned tweet on my Twitter. Every single one of those predictions played out completely. Every single one of them. I called the S&P, I called Bitcoin, I called dollar, I called so many things simultaneously. Is that by coincidence? I don't think so. Let me show you that real quick. Well, actually, no. You can go and look at that for yourself. Go to my pinned tweet, look at literally every single thing that is in that pinned thread. It's a thread. All 7 predictions, all of them correct. Every single one of them. So now let's see, why was this alliance reversal? And because I entered it literally at the wick of this candle, and I was extremely public about it. And also I posted about it in my Telegram and my Twitter. So if you go back to these dates, you will see that I actually entered over here and I exited literally up there. Okay, that's how I capitalized on it. Now let me show you exactly how I did that. So first off, we need smart money to be in longs, to have longs open. Where do we have that element? Well, yes, we have that element the third element. We have it over here, but we also have it from here because there's a double top. So smart money is indeed has longs open. Secondly, we need them to neutralize their shorts. We need them to stop out all the retail longers so that they can realize their shorts. That is a sell side liquidity. Here's your first element. And we also need bearish sentiment, which we get the minute price breaks under this trend line. So that is your second element. So here you have element 1, element 2, and element 3. So you already had a confirmed lion's reversal the minute we clear this liquidity. And then the reaction marks the bottom. So this candle marked the bottom, and that is when I long. Now, let me show you how you can trade this. For those who stuck until this point, you will learn how you can trade this. So the way you should be trading this is once you have all three elements, if risk to reward is present, then you need to enter a position. Now, the way you would do that is on this candle, all the elements are offered, but why would you not enter a position on this one yet? Because we hadn't seen a reaction yet. It's still going down. It's still reaching for liquidity. It's still reaching for liquidity, perhaps on the Ethereum chart, perhaps on some altcoin charts that Bitcoin affects. It's still reaching for liquidity, so it's not going to reverse yet. Here, you finally see it finds a bottom. You see this big wick. That's enough of a reaction. This is a medium probability reaction. A high probability reaction would have been after this up candle. That's a high probability reaction. Now, the lower the probability of the reaction, the more risk reward is typically going to be offered to you. So I would take the entry on this one. After we had this one, you would have simply longed the minute this candle closed, stop right over here, take profit. The take profit needs to be where smart money positions go back below the longs. So that means where they're distributing their longs, that's when you want to close your position. So they're going to be distributing their longs at the buy side liquidity, which is, yes, there's some here, but it is mostly over here. So that is why I closed around here. But I actually closed over here because I combined algorithmic theory with liquidity. Here was the first full hourly fair value gap, 26.2K. I called that on my Telegram. If you go to those dates, you will see it. So all of this is nothing new under the sun. It's concept that I've been trading for a very long time and I have a very good understanding of. If you want to join the Alliance, then that's the best place for you to learn about it. I'll try and sort out a way to pay through credit card. Until then, you can pay through crypto. Price is currently $160, but within the next 3-4 days, I'm going to bump it up to $200. So, yeah, if you want to buy crypto, you can do that through Binance. You can do that through Bybit, Kraken, whatever. BingX. There's so many exchanges where you can buy crypto. Coinbase. So many exchanges where you can buy crypto. Anyways, peace and have a lovely day, everyone.